Hello, my name is Joseph Lake and I'm the Global Economist at the Economist Intelligence Unit. For the next few minutes, I'm going to talk about our outlook for the global economy in 2015. The good news is that we think this is going to be the best year for the global economy since 2011. And a lot of that is due to the OECD countries, the rich world countries, which are going to be growing at their fastest rate for several years. Consumer spending will be boosted by the impact of lower oil prices, and interest rates have been cut historical lows in many countries. Starting then in the US. The US has just had its best year for job creation since 1999. Consumer spending in the final quarter of last year grew at its fastest pace in 9 years. And it's been helped by several different factors. Cheaper oil, as I said, is boosting consumer spending, but also American households are reaching the end of the debt deleveraging cycle. Debt levels now have come right back from the peak in the financial crisis, and households are having to use lesser of the money to pay down debts and have more to spend on other goods and services. So we think that the US economy will grow by around 3.2% this year. That will be the best performance from the US economy since the global financial crisis. Later in the year, it will face a headwind because Janet Yellen, the head of the Federal Reserve, will increase interest rates for the first time in almost a decade. That will create a headwind not just for the US economy, but also for economies around the world and emerging markets in particular. The Eurozone, while it has been kind of stuck in a quagmire since the financial crisis, we expect it to have its best year for several years this year. Part of that, again, is the impact of cheaper oil prices. But the other major factor is the QE that the ECB has introduced in March. That has pushed down the value of the euro and made European exports much more competitive abroad. And that will help the economy over the next year. But still, household debt levels and public debt levels are extremely high in a lot of countries, and that will continue to act as a real drag on growth. Abenomics is really starting to take a hold in Japan now, 3 years after it was first introduced. The government has made real advances on the fiscal and monetary arrows. The structural reforms were always going to be the slower part to come through. QE was increased in October of last year, and it's had a big impact, especially on the yen, the Japanese currency. This has weakened considerably, and that's been a boost to the domestic economy. Tourism has grown, exports are growing. We're also starting to see some signs of wage growth in Japan, which is crucial if the economy is to be kickstarted into a more successful growth path over the next few years. So Japan will be doing better this year. We think it'll grow about 1.3%, which is a big acceleration from last year when the introduction of the consumption tax really derailed the recovery. Last year, the economy stayed exactly the same size. After expanding in the first quarter, it contracted in the second and third, went into a recession, and then expanded again in the fourth. But the net effect of all that was the economy was the same size at the end of the year as it was at the start of the year. Moving now to China, which is going through a slowdown. Most countries in the world would envy its 7% growth rate this year. But for China, that's extremely slow. However, it's a good thing. China needs to slow down. Investment has been rising too rapidly over the past few years, and there's a bubble developing in the property market. The Chinese authorities are trying to manage this transition from an export and investment-led growth model to one that's driven more by consumer spending. The central bank has taken steps in the past few months, cutting interest rates in the face of disinflation in the economy. So China will have a good year this year. Around 7%, we think that's a healthy growth rate for the Chinese economy for this moment in time, given all the constraints it faces, particularly in the growth of credit. The rest of Asia and emerging markets around the world are really benefiting from this reduction in the global oil price. That has helped consumer spending. Consumers have to spend less filling their car with gas or petrol. They're spending less on heating bills. They're spending less on transportation costs. And the savings that they're making there, they can spend on other goods and services. So that's really helping emerging markets around the world. However, in the second half of this year, they're going to face a big headwind when the US Federal Reserve raises interest rates for the first time in almost a decade. We think that will happen in the third quarter of this year. September looks like the most likely time for it at the moment. This is going to lead to a flood of capital leaving emerging markets and heading back to the US, where it can now gain higher returns on very safe investment assets. That flood of capital leaving emerging markets is going to put pressure on currencies, similar to what we saw in 2011 with the so-called taper tantrum. Some markets, some economies have made reforms in the past 2 years, so they won't be as badly affected as they were in 2011. India and Indonesia are running now lower current account deficits and lower fiscal deficits, and they're in better place to withstand this tightening from the Fed. However, other emerging markets will be badly hit. Already this year, we think that Russia and Brazil will go through a recession. They'll also be hit by the capital outflows from the Fed tightening. They've been badly affected by the oil price slump, which has hit the energy sector hard in those countries. Mexico will also come under pressure when the Fed tightens. So that's our tour around the world. The upshot of it all is that it's going to be a good year for the world economy, the best since 2011, and it's going to be shaped really by the oil price slump, which is going to boost consumer spending for a lot of countries, but it's going to be a real drag on some economies, Russia, Brazil, Saudi Arabia, places like that. In the second half of the year, the story is going to be all about the Fed tightening and what that means not just for the US economy, but for the rest of the world as well. It's going to add another headwind to emerging markets and their growth stories, but we think that they're in such good condition that they can, for the most part, withstand that headwind, and we expect the global economy to grow at its fastest pace since 2011. Thank you very much.